Morning, everyone. My name's Alex Brandreth. I'm the Chief Investment Officer at Luna Investment Management, based in Manchester. Thank you to Piers for asking me to present today. It's always, well, I always think it's interesting to say what's going on in the world. And God, it's been a roller coaster over the last 2 years. And just when you think things are calming down, the events of the last month come through, or the sad events of the last month come through. So we're going to touch on that as well. So just to go through what we're going to discuss today, I'll give you an introduction to Luna. We work very closely with Pareto Financial Planning. Marcus can't be on the call today, but he does send on his regards, and we work very closely with Marcus, with Pareto and Luna as sister companies. So if you do have any questions or you want to know more about Luna or Pareto afterwards, please feel free to speak to either Marcus or myself. As I mentioned, there's a number of consequences of the ongoing events in the Russia and Ukraine. Obviously, it's the humanitarian side, which is the most important, and it's extremely sad. And our hearts go out to people in Ukraine based on the current environment. It's horrendous. But there has been impacts on commodity markets, stock markets, bond markets, currencies, etc. And we'll touch on that and give you an update on what's been happening from that perspective. I think whenever we see stuff like this, sadly, we've been here before. We've seen past geopolitical events, past wars, etc. And you can take information from history to see how markets have behaved. So I think it's important that we look at that as well, put things in context. We'll give a view on what's going on with the economy. How does this impact global growth? How does this impact UK growth? Inflation is extremely topical at the moment. I'm sure you'll be getting your bill statements through from the energy companies at the moment. I got mine through a week or so ago, and I nearly cried when I opened it. So there's that, but there's also kind of mobile phone bills, etc., which are coming through, which are quite high as well. And so we'll touch on why that's happening. And we're investors. We'll touch on what Luna does in a sec, but we'll give you an idea how to invest in this environment. So who are Luna? We are an appointed representative of a company called Thornbridge, who are based in London. Essentially, all that means is we're part of a network. Thornbridge provides us the compliance and the regulatory backdrop to operate within the UK. When you start in a business, Luna started in early 2020, which was clearly a good time to be starting a new investment management business. But one of the routes you can go down is to be an appointed rep or be directly authorised by the FCA. It's a lot quicker to go down the appointed rep route, so that's why we're an appointed rep. We are a discretionary manager. That means that clients come to us and we can make investment decisions at their discretion. So if one day we decide we wanted to sell, I don't know, Royal Dutch Shell or BP from a portfolio, we don't have to go and ask permission to do that. We go away and do that because we think it's the best thing to do. Financial advisors on the main don't have discretionary powers. So if they want to make an investment change or recommendation, they have to go back to the client and say, do you agree with this? Which can be a slightly longer process. And that's why we work with a number of financial advisors and managing portfolios and direct clients. As I mentioned at the outset, we're based in Manchester, we're in Spinningfields, but we look after clients across the UK, and the Northwest being our natural hub and home. Despite the fact that we're a new firm, or relatively new, 2 years or so now, that Luna's been set up by individuals that have worked within the industry for a long period of time, whether that be managing investments, as we do, but equally administration side, portfolio management, compliance, business and operations. So we've got a number of key individuals that have worked within the industry for a long period of time. And that team is continuing to grow. We've got another 2 people joining this year. Someone we've been in the industry for 40 years is joining shortly. So that years and experience is only going one way. Just to give you an idea of the size of Luna, I mentioned we started 2 years ago. We now manage just under 600 million of client assets. We think that means we're one of the fastest growing discretionary managers across the country, if not the fastest. And that's a reflection of the fact that we have key individuals that run in the business that have got very good, long established relationships with companies like Pareto, but throughout the UK as well. So what do we do? Essentially, we manage bespoke portfolios for wealthy individuals. It is truly bespoke. We speak to clients and understand what their needs and wishes are and their requirements, and we manage portfolios in line with that, whether that be ethical or sustainable, if someone's got a particular income need, and across different risk as well. So we have clients that want to take very, very low amount of risk to clients that want to take a high amount of risk. So we manage portfolios for different individuals in different ways. It's at the end of the day, it's the client's money, and we're just guardians of that and looking to implement it in the best way that in their wishes. We also manage and model portfolio service on external platforms like Aviva or Standard Life. That's only available via a financial advisor, and that is again very similar in that there's different risk profiles within that, and it's mainly invested in collective funds. And then finally, for inheritance tax planning, there are a number of different tools you can have to mitigate inheritance tax. And one of them is to invest in AIM companies. After 2 years of holding an AIM company, you qualify for business property relief, which means it's outside of your estate for inheritance tax purposes. We've managed an AIM portfolio for a very long period of time. And despite the fact that AIM is a smaller part of the equity market, it also has a number of well-established companies on there. So, for example, Jet2, the airline, is on there. The company that make Vimto, Nichols, is on the AIM market as well. Johnson Service Group, which did used to have the dry cleaning business, that just sold that a number of years ago, but they're also on AIM. So there's a number of well-known businesses that you will heard of on the AIM market that we're invested in there. There's also probably a number of companies that we invest in that you wouldn't have heard of, because that's our job. So it was really important to us that we worked with external bodies to come in and review what we do. It's all well and good that people know us and we've been around for a long period of time, but it was also important that a company like De Facto could come in and kick the tires. They looked at our fees, our processes, our individuals, our our online software, etc. And they came back and they gave us their highest rating of 5 stars and expert rated on our 2 core services, which is the model portfolio service and platforms and our bespoke offering that we give. And that's just been reviewed for 2022, and that's still the case. So we're delighted that we've been recognised by De Facto, and they've come in and given us their seal of approval, which is great. So I'm conscious that's a lot about us. I don't really want to talk too much about us because I want to concentrate on what's going on in the world, and that's what we're going to do now. So clearly, politics is now more live than it ever has been with what's going on with Russia and Ukraine, but it's definitely been the key driver to markets over the last month or so. We were expecting economic growth within the UK and developed nations to start to moderate in 2022 anyway. If you go back, 2020 was clearly an horrendous year for economic growth. 2021 was then a blockbuster year for economic growth. You've had the worst and the best year for economic growth side by side. It's very difficult to keep up to the levels that we were in 2021. That being said, we're still expecting it to be a strong year, and we'll go through that shortly. I've touched on inflation already. It's very topical. You've also got the Bank of England meeting this week on Thursday. You've got the Federal Reserve meeting going on now in the US. It's not just going on high in the UK, it's high globally, and we'll touch on the reasons for that. As I said, interest rates are being discussed now by the key central banks. It's likely you'll see interest rates go up on Thursday again for the 3rd time. And one of the reasons for that is it's not the current commodity-based inflation you're seeing, it's because of what's going on with the employment market and how strong that's been since the COVID recovery. And we'll touch on that and the impact on wages. And it's, if we were doing this slide or this presentation 3 months ago, I think COVID would be at the top of the list. It's still very present and with us, and it's still having an impact on different economies in different ways. So we'll just touch on COVID as well. The first thing I want to really focus in on is the ongoing issues between Russia and Ukraine, the impact that's having on markets. And although I'm going to go through a number of different points, but I'm going to start on commodity markets because that's probably seen the biggest impact. within the recent developments. On the left-hand side of this chart here, you can see the different exports that Russia send out into the world, with the biggest being crude oil and oil-related products at 37%. The next biggest is natural gas to Europe, and they're two of the commodities that have been seen biggest rises over the last few weeks and months. It's not just that though, you've seen other commodities behaving very strangely. Nickel, for example, they had to stop trading on the London Metals Exchange last week because of what was going on with the nickel market. So there is broad impact across most commodities. You're starting to see food prices go higher because of the amount that's made, not just in Russia, but also in the Ukraine as well. So commodity prices in general are moving higher. Precious metals are being seen as a safe haven asset at times like this as well. So the gold price has moved higher. It's come back a little bit more recently. And so it's commodities that have really moved significantly, which has impacts on different markets. So let's just touch on the oil price. The oil price, as you can see here, is bounced sharply from the 2020 low on the right-hand side, where Brent got down to $20. It actually went negative for a very short period of time, the West Texas oil price. But you can see how strongly it's bounced back because economic growth has accelerated, and then more recently, because Russia is the third biggest oil producer in the world, it's really put concerns about what's going on with the oil market, to the point that we actually got to $140 at one point a week or so ago. Today, it's back down to $100. And that just highlights a few different things. One, that we are very reliant on oil still. We are in this transition to green technology and being more environmentally friendly with the energy that we produce, but we're not there yet. And because of that, there's not been a significant amount of investment within the oil market. It's not very often that you see new oil rigs coming on stream. And in fact, banks and governments are trying to restrict that as much as possible because of what's the environmental consequences of that. So there's been underinvestment for oil for a long period of time. And then at the same time, demand's coming back. So this is why the oil price has been so strong. And this dynamic isn't going away in the short term. We actually think we're going to have a higher oil price for a long period of time, which I'm sure you've seen the prices at the pump. That's clearly an inflationary impact because the cost of filling up a car is going up all the time. But it's not just that. Oil is used across manufacturing. Oil touches everything. So it's inflationary across the board. And that's why you are seeing higher inflation numbers coming through at the moment, because you've had this commodity push. So that's the commodity side. It is changing. The UK and US have announced that they are going to ban imports of Russian oil from the end of this year. Interestingly, European nations haven't followed suit just yet. And that's a function of the fact they are more reliant on Russia. The UK and US aren't as reliant on Russian oil, and they're not as reliant on Russian gas. The UK doesn't get any gas from Russia. It's mainly in Europe that's coming through, in domestic and continental Europe. So what have the other impacts of the crisis been? Well, it's been a volatile ride for equity markets, as you would imagine. In risk-off periods like this, equity markets tend to fall as investors look for safe havens and think about the consequences that this can have on specific companies. It's the impact on markets has been location-based. So the closer you are to Russia, the bigger you've seen the falls in the share prices. There's a couple of Russian-listed commodity producers, Evraz, which is now suspended, and Polymetal. Their share prices have fallen by about 90% or so. Fortunately for Luna, we didn't have any clients invested in them, so we haven't had any of those falls. There are a number of Russian-specific companies as well that are listed out there. There's a Russian stock market, which has fallen significantly to the tune of about 90% as well. So investors globally, as rightly so, are punishing Russia from an investment perspective and disinvesting. You've seen companies doing this specifically in closing down operations or stop distributing products quite significantly to Russia as well. You have to feel sorry for the Russian people, though, because clearly it's not necessarily their war with what's going on. The next biggest falls after Russia and emerging markets have been Europe because of proximity. The UK and US stock markets have fallen a little bit, but they've been slightly more immune to what's been going on compared to European nations. So that's what's been going on in the equity market. The equity market over the last week or so has started to bounce back. Equity markets tend to move in anticipation of events. This is a geopolitical event that we've been in our radar throughout the course of this year, and towards the end of last year that was starting to bubble up, and that had started to be priced into stock markets. And it is a fact that you see quite common within stock markets, that they move in anticipation of events. So if you go back to the COVID crisis, the 23rd of March was the day that Boris Johnson's told the country that we're going into a national lockdown. So you would think that would be the worst day for the stock market. Well, it was actually the bottom of the stock market in March 2020. And that's because markets had moved and expected this event to actually happen. And then they were looking forward to when does the economy reopen and restrictions stop. And it's essentially what the market's doing now. They're looking through the fact that we are in war, we know we're in war, but and expecting at some point that this is going to come to an end. So that's why it actually, from an investment perspective, it could be a very good time to be investing at the moment, because you're in the eye of the storm. It's dark, it's just before dawn. In terms of other markets, currencies have been impacted in very similar ways. So you've seen safe haven currencies like the yen and dollar do well. The Russian ruble was completely collapsed, and they've had to increase interest rates in Russia to try and keep inflation down. And bond markets have also been seen as safe havens, but again, linked to what's been going on with the equity market, that's reversed somewhat over the last week or so. Bond yields have moved higher because everyone's now concentrating on the impact that this is going to have on inflation and what central banks do. So that's been what's been going on more recently. As I said, we do sadly have other events that we can go back and look through in history and see what the impact has been. So just to select 7 different events there, and this focuses on the S&P because the S&P has got the longest track record. And you can see that the one-day impact after an event is usually the markets fall by about 1.5%. 9/11 was the worst day when the stock markets fell by just under 5%. But you can see that there can be a slight positive when there's an event coming through, and the Suez crisis was one of those as well. Interestingly, the one day depends on when you want to look at in terms of the actual invasion. Was it the 21st of Feb when they recognised the next as a region, and the market fell 1% that day. On the 24th of Feb, when Russia then formally across the borders and started to invade Ukraine, the stock market was actually up 3.7% on that particular day. So you can see that markets, despite the fact that Russia was invading Ukraine, stock markets can still deliver positive environments, which is a surprising phenomenon in this environment. That it's not just a one-day event though. You can see here the total drawdown, so the peak to trough in terms of the impact to markets is around 6% on average. The terrorist attacks on 9/11 were the worst when the market fell slightly more than that. And then you can see how long it normally takes to find a bottom, and then how long it takes to recover. And we're now past that 2-week period, that 15-day period, which is on average to get to a bottom. So that's one of the reasons why, as I said, markets could start to perform pretty strongly from here. And you can see how quickly markets do bounce back. It's also important to remember that there's events here, but there's also other things going on within economies. There's interest rates decisions being made, there's growth which is going up or down, and inflationary consequences as well. This chart again is very similar, but just looks at different asset classes. Again, focus on the US. Large cap stocks in that first column, smaller companies where you're taking a little bit more risk, but they can grow significantly, bonds and inflation. And it looks at returns over different time periods. So the average return from investing in a large cap stock is 10%, and the average risk is 19%. But actually during periods of war, you can see that the return expectations go up. And the volatility goes down, which is quite strange, really. As I said earlier, you'd expect it to be the other way around, where returns are being impacted by the fact that you're in war and the risk goes up. But the stats and the data suggest it's actually the opposite. And that's for the reasons that I mentioned earlier, because markets are always moving in anticipation events. And when you're in war, then the market's looking forward to seeing, well, when you're going to be out of war, and when are things going to be better, and what's the impact that that's going to have. So that's one impact. You can see the inflationary impact on the right-hand side. This does tend to be more inflationary when you're going through periods of war, because of the fact that you can have supply shortages, commodities can be impacted because of, during this as well. So it's clearly has an inflationary impact going through this. I'm going to just start concentrate on that now and just move more broadly to what's been going on. As I said, it was expected that 2022 would be a weaker year for global growth. That's on the fact that we had such a blockbuster year last year, particularly in the UK, where restrictions were easiest. But also, as we're coming into this year, we had the Omicron variant, which is still having an impact, particularly in China at the moment. We'll touch on that in a second. But we are also seeing this inflationary impact that's coming through, starting to squeeze the consumer. And that's coming through in so many different ways. I've already mentioned energy prices. I've already mentioned filling up your car. But it feels like everything's going out. I went out for a meal yesterday and it felt like it was 10, 15% more expensive than it was 6 months or so ago. My phone bill is going up by RPI. I mean, no one even uses retail price inflation anymore, but it's still increased significantly. It feels like the costs associated to living are going up significantly. And this kind of put some numbers on it. So you can see the strength of last year where the UK grew by 6.9%, and that was moderating to 4.7%. That number has to be revised lower because of the events that's going on at the moment. So that number is probably closer to 4 now. But you can see there that it's still a strong year. The UK on average grows by about 2%. And good times. So this year, despite the fact that growth is slowing, is still going to be double what you'd expect to see in a normal year. So it's still a positive environment to be in. And that's a function of the fact that we're still getting back to our old life, following on from what's happened over last year with COVID, last couple of years with COVID. That we're in a situation now where all restrictions have been lifted. From Easter, you can travel without having to do any of the COVID checks, etc. And people are gradually getting back to enjoying themselves. And they can do that because savings ratios are still very high within the UK. COVID has meant that individuals have been able to save a lot and pay down loans and pay down mortgages. So the health of the UK consumer going into these inflationary pickup is actually, is never been stronger. China, on the other hand, is definitely being impacted. China is, if you weren't aware, having to increase restrictions at the moment. It was already expected that Chinese growth would be weaker. Again, this number needs to be revised lower. And it's a strange situation where the UK economy is going to grow quicker than China this year, and that's not been the case for a very, very long period of time. So China is definitely slow, and that has an impact. China is the second biggest economy in the world. It has impact on supply chain. If there are certain regions are being closed down, we've already seen how long it can take goods to be shipped across the UK, and businesses need to adapt and evolve to that changing landscape in terms of where supply is coming from. I want to give some positive news as well. The UK economy is back in November last year to above it where it was pre-pandemic. So we have seen this big V-shaped recovery in the UK economy to the point where the economy is now bigger than we were pre-pandemic, which is great news that we have been able to recover in such a weird environment that we've been in. And this just touches on what we said earlier, that the Russia-Ukraine war is going to lead to a reduction in global growth because it will have an impact. It's going to increase commodity prices, that's going to reduce consumption, and it's clearly not good for those regions in terms of economic growth as well. So this chart here focuses on the US. I've mentioned the UK consumer already, and this is the same picture across Europe and the US. So on the left-hand side here, it shows consumers' net worth. and you've got the current cycle, the current economic cycle in that purple line, and you've got the financial crisis in that longer black line. And you can see, I'll concentrate on the global financial crisis first, that just for a year before, so 4 quarters before, you can see that the economy was still moving up, so that's why that line was going up. You can see that almost a year or so after the financial crisis started, you can see the impact on consumers. Their wealth was going down by about 15%. It took about a year. But then you can see how quickly things bounced back as we move through 2020 to 2019. And it took roughly 20 quarters to get back to where we were. So that's about 5 years. So it took you 5 years to get back to where you started after the financial crisis. And to get to where we are now, the current cycle has been a bit strange. I mean, this is the first recession that we've had where consumers actually come out of it feeling wealthier than they came in. You can see, yes, there was a small blip for about a minute, but then such was the impact of COVID that people kept their jobs and they were spending less. So it actually made us feel wealthier and wealthier. And then the stock market took off and the house market took off as well. So that's been a strong impact in the fact that we are all feeling significantly more wealthy than we were pre-pandemic. On the right-hand side, there has been delays in supply chains, and you can see that's because the bounce back in goods has been a lot sharper than expected. That's because we can get things delivered. People have been shopping more online. The demand for goods has been higher, and that's a function of why we are seeing some supply chain issues as well. It's because demand has been so strong for certain goods. Services clearly was more impacted because you couldn't go out to get your hair cut, you couldn't go for a meal, and that fell sharply. But you can see that's almost back to the trend line it was beforehand, and it's growing nicely again. So that's just the US, because we've got the data there, but it's exactly the same picture within the UK, Europe, etc. So what's been the impact of this? And this is one chart that is pretty key at the moment, and we've already touched on inflation a few times. You can see here that we're now the highest in terms of inflation we have been for a very long period of time. This chart goes back 10 years. This is up to date. So the inflation print of 5.5%, which was in January, is that final number. Now, I think there's a few points to make here. Whenever you're coming out of recession and demand comes back strongly, it's always a period where inflation bounces back. You can see right at the beginning of this chart, that was exactly the case when we went out of the financial crisis. Demand came back very strongly and inflation was higher. And then it fell away over the next few years. But that's exactly why inflation is high at the moment, because demand's been very strong. And on the flip side, I've already mentioned some supply side problems. But the real driver to inflation at the moment is what's going on with the commodity markets, energy prices, oil prices, etc. And despite the fact that we've got bills that are coming, a lot of this data isn't in the price yet. So despite the fact that we're already at a high, inflation's over the next 2 months is going to accelerate even faster. The Bank of England have already projected that inflation is going to get to 6% next month. Well, that number is probably 7 or 8% now. US came out with data yesterday with their inflation figures running at 7.9%. So I wouldn't be surprised if you see very similar data without the UK over the next few months, that we hit kind of 8% or so from consumer price inflation. I mentioned retail price inflation earlier. That's currently 2% higher than this figure, so it's at 7.8%. That could easily get to 10% or so. And cheeky people like O2, who I use for my mobile phone, are using retail price inflation to push through higher prices as well. So it's worth being aware of what's going on with RPI as well. Now what happens then? I mean, it's very difficult to say. And if we were doing this presentation 2 months or so ago, we would have said inflation is going to peak in April, and then it's going to start to fall away because the commodity impact starts to reduce. The oil price can't double again. So therefore inflation needs to start to moderate, and it will start to moderate. But with the ongoing Russia-Ukraine war, it's very difficult to say that, because the oil price is bouncing all over the place. I highlighted earlier, it got to $140 and now it's back down to 100. So that's going to have an impact on petrol prices. The biggest impact is actually what's going to go on with the energy market. Now, in the UK, it's only reviewed twice a year in April and October, the energy prices. That's why it's coming through in April. Now, if energy prices and natural gas prices stay high for the next few months, then you could easily see another increase in October. So the point we're trying to highlight here is inflation is likely to stay stubbornly high and certainly above the Bank of England's target, which is 2% for CPI. So inflation is going to be above trend. The next dynamic that is unknown, but we're starting to see, is wage price inflation. We all on this call are suddenly having to pay 5–10% more for certain goods and services. So we're going to have to go to our employers and say, well, the cost of living is going up. How are you going to reflect my salary on this environment? And you are starting to see that happen already. There was some wage data out from the UK yesterday. Unemployment's down to a low, and wages are starting to go up by 5% or so. That's what the Bank of England are concerned about. It's that impact, because that's another leg to higher levels of inflation as well. So, here's the unemployment chart. So that's what is the Bank of England are focusing on, and that's why you're likely to see interest rates going up to try and keep inflation down. Unemployment. So this is the unemployment rate going all the way back to the 1970s. You can see what happened in the 80s when unemployment really spiked. You can see what happened, the COVID crisis, where unemployment spiked temporarily. Please remember that we had the furlough scheme. Unemployment rate would have spiked even more if we hadn't had furlough, and we would have probably got back to the levels that we saw during the financial crisis of 8% or so. But unemployment has been very quick to fall back. The latest number was 3.9%, which is pretty much full employment within the UK. There's a few reasons for that. The workforce has shrunk during COVID. People have retired earlier. People have stopped jobs to be either teachers at home or to care for elderly relatives. So COVID has definitely shrunk the unemployment pool. You've also seen people returning out of the UK to EU nations, which has had an impact because Brexit's clearly happened over this period as well. So the unemployment pool of individuals in the UK is probably the lowest it's been for a period of time, and that's why you're seeing the fact that the labour market is very tight. This chart again goes back to the 70s, and it goes to every company in its survey and says, well, what's the biggest and most important thing for you as a business at the moment? It's done by the CBI, and you can see that the biggest driver of this survey at the moment is labour market, and it's not just unskilled jobs, it's skilled labour as well. It's very difficult to find good people at the moment, and it's the highest it's been for a long period of time. So the labour market is very tight, and again, that only feeds through to higher wages as well, because you need to try and entice people from other jobs, which means that you have to be more competitive with the salaries that you're offering. So wage inflation is certainly coming through. I think there's a tendency to think that the UK is special. It's not. We're a global nation. This is the same chart but it shows US unemployment. Now, US unemployment spiked at 15%, so it went well past what happened in the financial crisis. They didn't have the furlough scheme, so that's why unemployment spiked so sharply during COVID. But you can see then how quickly it was to fall away, and it's continued to fall more recently as well. So this isn't just a situation that's going on within the UK, it's happening within the biggest economy in the world, in the US as well. And back to that point about wage inflation, this is the Atlanta wage tracker. You can see it has been drifting higher over the last few months. And that's what the Federal Reserve in the US and the Bank of England are very much concentrating on. And it's only going to continue to move higher because of the impact of the commodity prices that we've been talking about already. Again, a very long chart showing where interest rates are. I think it's important to put this into context. Back in the 70s, when you had interest rates of commonly over 10%, and for the last 13 years since the financial crisis, interest rates have basically flatlined. Yes, they've increased to 1% or so. At the moment, they're 0.5%. Going to 0.75, I would imagine, tomorrow. But you can see that they're still low. I mean, interest rates really aren't moving significantly. So this has consequences for investors. As I said, if you've got inflation running at 8% and you've got interest rates at 0.75, that's a 7.25% difference between cash and inflation. So in real terms, if you're hoarding cash, you're losing out by over 7% this year, which is astonishing. And there's a tendency within our industry to focus in on what's going on with the equity market because that's what people are interested in. But to be honest, this is the most important thing that investors should be thinking about. What should they be doing with cash when inflation is running so high? That's both at a business level, but it's both at a personal level as well. And it's not just cash that's impacted by this; it's bonds, it's other investments. Government bonds have also fallen significantly over the last 10 years because investors have used them as a quasi cash asset, which has meant that the returns on them are pretty low. You get maybe 1% if you're going to buy a government bond for 10 years nowadays. So you're still going to lose out by about 7% a year, which is pretty high. Where are interest rates going? This chart was done at the end of December. You can see here what is expected within the UK and the US. Essentially, that the UK and US interest rates are going to get to 1.25 to 1.5% over the next few years. Despite the fact that the events that are going on with Russia and Ukraine, we'd expect that to continue to be the case. Europe's probably a different picture. You're maybe not going to see European interest rates moving from negative because of the proximity to Russia and the fact that they are more reliant on natural gas and their consumers are going to get squeezed even more. So we're not expecting anything from the ECB at the moment, but we are expecting interest rates to continue to move higher in the US and the UK. But back to what we said earlier, going to 1.5%, when you think about it in a long-term perspective, is really not a very high level at all, despite the high levels of inflation we're getting. And the reason for that is because we are so heavily indebted. This chart just shows different countries and their debt levels to GDP. The top one there, Russia, you can see that they've been paying down debt and their economy was actually very strong before this. Obviously, they knew what they were doing in terms of trying to make sure that they weren't reliant on developed nations for debt. So they've been paying that down as much as possible. But you can see the UK in here. The UK debt is over 100% of the GDP of the economy, and we're at that higher end. So a 1% increase in interest rates, which we're going to see, means that the amount of interest that we have to pay on just servicing that debt is the highest it's ever been. The impact of inflation and some government bonds are linked to retail price inflation is having a big impact as well. So the amount of the cost of our debt is going up. And it's probably not something that governments want to talk about, but debt levels stay the same. So they actually want inflation because it erodes the real value of their debt over time. So that's why you are starting to see bits of inflation coming through. Now, Japan is off the scale in terms of its debt levels, but it's also been able to keep bond yields low, despite the fact that they have as much debt as they do. And as I said, the UK isn't special in any way here. It's developed nations in general have very high levels of debt. So that's why interest rates globally will be kept lower, because it's the cost of servicing that debt increases significantly. Now, I mentioned COVID, and it's weird that we haven't touched on it so far. Again, it was the main thing we've been talking about for the last 2 years, and now it's the 6th or 7th thing that we discuss. And that's a reflection of the fact that the vaccination programme in the UK has been so effective. This is a global chart, so you can see that there's been £5 billion doses that have been administered and fully vaccinated, and how many boosters that have come through. The global stats are that we're about 55–60% vaccinated at the moment. So there's still a long way to go to vaccinate the rest of the world. And that's going to have an impact, as you've seen, because when vaccinations do come through, it means restrictions can lift and economies can accelerate, like you saw within the UK last year. So that's another reason to be positive for global growth. Vaccination rates are going to accelerate through developed nations, and that means restrictions can be eased and economic growth can accelerate. Within the UK, we're running around 75% fully vaccinated at the moment. So there's still some progress to be made to get through there, and clearly there's changes going on with young adults and children at the moment as well. So that's the world that we live in. It's a very fast evolving world where events are driving things in the short term, whether that be Russia and Ukraine or COVID. So what do you do from an investment perspective? Because ultimately, at the end of the day, that's what we're here to do. We're here to look after people's savings. So the first thing to highlight is back to what I mentioned earlier with that cash rate that you're getting at the moment and what you can get in the bank compared to the inflation that we're running at. And the word that describes that is financial repression. Over time, people's savings are being eroded because of the high inflation that's coming through, and that's reducing people's spending power over time. This is an environment that we've been in since the financial crisis. It's not anything new. We've been keeping interest rates low for 13 years now. And inflation, although is very high at the moment, has been higher than what you've been able to get in the bank. So this is really not something that's new. At the moment, though, it's very key because of the fact that the difference between inflation and interest rates is the highest it's been. The compounding impact of this over time is significant. So yes, it's big on one particular year, but over time that gets bigger and bigger because of the impact of compounding. This isn't something that's going away in the short term. As I mentioned, interest rates might get to 1.5% in the UK, but the Bank of England's target for inflation is 2%. So the Bank of England are targeting inflation above what they're setting interest rates. So this problem is not going away in the short term at all. Stock markets, I think this is one of my favorite charts at the moment, just to explain that stock markets move in anticipation of events. So here you've got the economic cycle, which is this blue line. And then the red line, you can see how stock markets react and behave. So you can see here that the stock market moves by, on average, it's about 9 months before what's going on with the economy. The stock market is a forward-looking indicator, so it gives you a good idea of what's going on within certain economies. And back to the point that I mentioned with COVID, the stock market bottomed here a few months before the economy actually bottomed. So the market bottomed in March 2020, and it was rallying despite the fact that the restrictions were still significant in March 20 all the way through to June. So markets move in anticipation of events. We think we're in this expansionary mode. We've gone through recovery. 2021 was the year of recovery. Economic growth is still going to be positive for in the UK and in global nations despite recent events. So you can see there that tends to be a good period to be invested in stock markets. And at the moment, you're almost going through a mini recession in terms of what people are expecting because of Russia. So it's actually, you're at this point at the cycle again on a short-term basis because of the recent events. The time to be worried about stock markets and investing is 9 months before the peak, and we certainly don't think we're in this. Such economic cycles on average last 6 years, so we're still a very long way away from thinking that we're at these peak levels. When you go through periods of volatility like this, there is a tendency to panic and sell exposure, and our view is that's fundamentally the wrong thing to do from an investment perspective, and history has taught us this over time. So what this chart shows, it's the FTSE All Share. What happens if you remain fully invested over a long period of time? You tend to get an average return of just over 7% from investing in the UK stock market. Now, what would happen though if you missed the best 10 days. And at the moment, you are seeing some of those periods. Markets fall heavily, but they bounce back heavily as well. So you are seeing some very strong days from stock markets at the moment. So it's very appropriate to be thinking about this. So if you miss those best 10 days, just 10 days, this is over 30 odd years, then that impacts your annual return by over 4%. If you miss the next 20 days, you basically make no money. And if you miss the next 30 and 40 days, you actually make a loss. So it is important to remain invested and ride through periods of volatility like this. We're actually doing a lot more buying over the last few weeks to take advantage of lower market levels during this environment. But it's fundamentally the wrong thing to be doing is to be selling, in our view, at the moment. Yes, things could get worse before they get better, and that could see markets slightly weaker in the short term. But thinking longer term, it's better to remain invested. And just a quick guidance of what a Luna portfolio looks like. This is for a balanced portfolio. We do have a bias towards equities at the moment for the reasons mentioned in terms of where we are in the economic cycle. We do like the UK equity market. The UK equity market has been hated by global investors for 5 years because of Brexit, which has left the UK very cheap. That's why you're seeing companies like Morrison's getting bid for. So it has left the UK very cheap, and that's been noticed by activist investors and private equity in terms of acquisitions. Right at the bottom of the chart, you can see that we've got 0 in cash for the reasons we mentioned. We're very low at our fixed income allocation. We will always have an element of fixed income within a balanced portfolio for diversification benefits, but we're very low in terms of our weighting there. And that means that we're looking to alternatives to get the balance within the portfolio. The other point of highlighting this is, we are well diversified globally across different markets. The allocation to emerging markets is very low. Our allocation to Russia was negligible. We had very little exposure to Russia. Full stop. It's not been a stock market that we'd ever directly invested in. So it's clearly saved our investors a lot of money this year by making that decision. So I'm just going to summarise, and we will open up to questions. It's very sad what's going on. We can't move away from that. It will have an impact to reduce global growth, and as you've seen with commodity prices, it will mean that inflation moves higher because of the oil price. How to position for that: have a low allocation to cash and fixed income because of the real return impact that's coming through. Look to alternatives that can help provide diversification. We're still in this economic cycle, as I mentioned earlier, in a positive expansionary stage, which is a time to be investing in equities. We haven't touched on it, but it's been very volatile in different parts of the market. So the US and technology has been particularly impacted this year, and that's where kind of more growth style comes through. Whereas the UK, because it's got a big allocation to banks, miners, and oil companies, is seen as more of a value market. It's important to remain diversified and not have a bias towards one or the other, in our view, at this part of the cycle. The UK stock market has been one of the best performing stock markets globally this year, which has, again, helped our investors. And that's because the UK fundamentally looks cheap. Everyone's already left over the last 5 years. There's not a lot of sellers there, whereas a lot of investors have fallen in love with the US. And unfortunately, when events like this happen, it creates opportunities. It creates opportunities from an investment perspective. Companies fall where they have no exposure to Russia just because of sentiment. Certain investments fall more than others. And our job during periods like this is to look for those businesses, to look for good quality businesses that can withstand the test of time and deliver good results in the future. And that's something that we fundamentally have within our DNA at Luna, is to concentrate on good quality investments all the time. That's what protects us during environments like this. That helps us sleep at night. That helps our clients sleep at night. That's what's important during times like this, is to stick to quality. So I'm just going to stop sharing that now, and over to yourselves, and if you've got any questions at all. Okay, it doesn't look like we have any questions. I just wanted to thank you all for dialing in today. Thank you for your time. I appreciate you all busy people. I hope that was useful in terms of what's going on within the economy, more backdrop, the impact that this is having on things like inflation and interest rates. The Bank of England meeting is tomorrow, so if I'm going to be wrong, you'll find out very quickly. But the expectation within the market is that interest rates are going to continue to move higher tomorrow in the UK and tonight in the US. So we'll keep an eye on that and what the central bank have to say. So thank you to Pierce as well. Thank you for today. If you do have any questions, please feel free to email. And if you want the slides or anything like that, please feel free to ask. We're more than happy to help. And if you'd like to talk about Luna or speak to Marcus at Pareto, please feel free to give us a shout as well. Okay, all the best. Thank you for your time. Bye now. Bye.